All right, so let's begin the highlight of the show, active funds and fund managers that got the market sentiment right. Yes, today on the Money Show, we will analyze the fund strategies across market caps that were able to make right calls in terms of their exposures to specific sectors and stocks. And for this, we are joined by Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth. And good evening, Feroze. Welcome to the show. And you've got an in-depth research ready with you about the funds and hit fund managers strategies as well. But then, before we proceed with the details, I really want to understand what kind of strategies on a broader level have worked for what kind of funds. If you could just give us an overview.
Yes, Kavita, there are several strategies which have worked. Some have not worked in different periods of time. If you look at the most contemporary place, what has worked has been value. Post-COVID, value has always outperformed the broader market largely. But yeah, if you break that down into different phases of super bull phase, like last financial year was not a great financial year from a Nifty standpoint. But this financial year, we've seen about Nifty go up about 11%. So to answer your pointed question, dividend yield, which is also in effect value, because quite a few dividend yield stocks were quoting at reasonable valuation. So value, dividend yield have done phenomenally well post-COVID. What has also worked in pockets is the contra fund. Because somebody taking a contrarian bet last year made a lot of money because the markets were not a one-way street. So these three have stood out. Of course, diversified funds have done phenomenally well too. But in this financial year, if you see, when mid-caps and small caps have run up beautifully, mid-cap as a category of the full funds have given 28%. But if you compare that with the relative benchmark, they've underperformed. In spite of 28% return, if the index has delivered 33, that has one big inference to make. Whenever the markets run up significantly, it becomes difficult for a diversified fund manager to even catch the index. So big return, bad alpha. That's the same theme with small cap, if you notice. Small caps as a category average have given 31%, but they've still underperformed their benchmark by 9%. So for an investor, he's happy that he's got 31%. But alphas have been bad. That's because when the market is running up, if there are 250 stocks in the small cap index, as a fund manager, you don't believe in all of them. So you're going to be very picky, and some stocks which you left out from your portfolio run up in this whole chase of liquidity.
All right, so now let's get into the analysis of the research that you have ready for us. We're talking about active strategies where obviously the investor gets the benefit of having a fund manager attached to their fund who takes care of their money. So when we talk about these funds who've got the calls right, what were your parameters while making this list?
Yes, Kavita, this is predominantly past performance. It's a dissection of past performance. That definitely, before I get into that, also it's from a disclaimer standpoint. Past performance is not the best way to select a fund, but this is just to dissect and see whose strategies have worked. Now, in the large cap category, there are two funds which have done very well, which is the Nippon India Large Cap and HDFC Top 100. Both have a little diverse. They have a diametrically opposite strategy. Nippon Large Cap is reasonably a growth principle with 21 PE, but HDFC Top 100 is a value principle with only 15 price to earning for its whole portfolio on a weighted average constituent basis. So Nippon and HDFC, both one from the growth side, one from the value side, they've done very well. Now, what has attributed to this performance is both these funds have had their top exposures in terms of sectors as banking, IT, and diversified FMCG. So both of them have the same sector allocation, and that's why both have done well. One has not been so sensitive to value. The other has been very, very specific to have a 15 PE in a market like this. Is a conscious decision at the HDFC fund level to keep it value. So these are the two funds on the large cap category which stand out, and they've generated alphas of about 5.7% and 2.2% respectively with their benchmark.
So what has been a sector allocation, and looking at the large cap category and the lull movement, these funds have outperformed. What do you think was so unique and different about these funds and the exposure to different sectors and stocks?
Yes, Kavita, if you look at some sectors have done phenomenally well in this almost 6-month period, which we are talking about from 1st April till date. So what has worked is banking has delivered very well. Their valuations are not as high. Relatively, they are higher from where they were, but there are so many sectors which are commanding 40, 50 PE as well. But in that space, banking is still in the range of 20, 25 PE. Both these funds have an exposure of 25% in Nippon and 30% in HDFC are from the bank exposures, which is a high exposure because Nifty itself has a 33% exposure to banking and financial services in total. IT as a sector, what it did was it had done very badly. Bottoming out was clearly seen in this financial year. After the June quarter results, you saw bad results resulting in stocks moving up. That's a huge sign of a sector bottoming out. IT's reversal and bottoming out has contributed to 5-6% alpha of the IT index over Nifty. And that's really contributed to these alphas. So these two sectors where they have an exposure, top two exposures have done well. They've also had FMCG, which both of them had an exposure of close to 7% in diversified FMCG. All these sectors have generated some alpha to Nifty, and that's helped them to beat their respective benchmarks.
All right, so large cap category, Nippon India large cap and HDFC top 100, alpha 5.7 for Nippon India large cap and for HDFC top 100, 2.20. We move on. Feroze, the next category in focus for you is large and mid cap, is it?
Yes, absolutely, Kavita. The chronological order, once you've finished large cap, then you go a little more adventurous and go to the next 150 stocks, which are called mid cap. So large and mid cap is the next category. Mahindra's Manulife large and mid cap has done well. Large and mid cap for a year like this year has generated good return for the fact that mid cap exposures of 30-40% these funds can carry. And they do also, both these funds, Mahindra Life large and mid cap and HDFC large and mid cap, because of their mid cap exposures and the mid cap index delivering significantly better than Nifty, has resulted in their both these schemes giving an alpha of 1.3 and 2.7 with respect to their benchmark, which also has mid cap. So I'm very happy that a fund could beat the benchmark in spite of having mid cap weightage, because standalone mid cap funds have not been able to very comfortably beat their own benchmark. So these two funds have shown some degree of resilience in terms of lower volatility and still delivering an alpha.
Talking about the strategy, because it's a large and mid cap category, do you think the fund manager has a bigger universe to select from, and so a lot of things depends on the kind of exposure you have towards sectors and stock, and what is it for these funds?
You're absolutely right, Kavita. See, if you have two large spaces, large and mid cap is top 100 plus the next 150. So you have a reasonable space of 250 stocks. And also these guys have the freedom of having some exposures to small cap. So in a large cap, people will definitely not venture into small cap. Like the large cap category, the two funds I discussed have negligible exposure to small cap. Of course, Nippon has 4-5% exposure to small cap. But since it's a large and mid cap fund, the fund manager actually expands his tail and also tries to venture out in the small cap space. And that's a very smart thing to do in a space in a year like this year, like Mahindra Manulife large and mid cap has 19% exposure to small cap, which is not a small exposure by any stretch of imagination. And that's given him some extra alpha. And they've also maintained some 4-5% of cash position or cash equivalent. And so to answer your pointed question, yes, it gives you a larger canvas. Point two, in a large cap fund, it's more top down kind of a strategy where the fund manager is very, very specific in terms of which sector, what weight. In mid cap and large cap, as a combo, you can still follow a stock specific bottom up strategy because of also the small cap exposure.
All right, so that was large and mid cap. The next category would be for you, a mid cap?
Yes. Again, going in the chronological order of market cap, mid cap comes to the next category. In this category, Nippon India Growth Fund, which is a very, very old fund, way back in 90s it started. That fund has delivered a great kind of alpha. The alpha is from a perspective of course, the mid cap index. It has generated minus 1.1 alpha. In spite of that, it is in the top. So this is the point to note as an investor. That means all mid-cap funds in this period of close to 6 months have underperformed their benchmark. Why does this happen? When the mid-cap index runs up and creates new peaks, it becomes very difficult for fund manager to pick all those 150 stocks because he would not like some stocks in terms of valuation, governance, management, or any other risk which is there. So the best fund in the mid-cap category is still negative alpha with respect to the benchmark, and that's Nippon India Growth Fund. The next one is Mahindra Manulife Mid-Cap Fund. That is also the second best fund from a alpha standpoint, but it's still minus 1.5.
And so this also creates a case to have a passive mid-cap fund?
Kavita, in my opinion, when you get into mid caps and small caps, mid caps not so much, but still, I would not buy index funds in mid cap category because it's about managing risks. When you're managing risks, there are some stocks which will run up significantly because of their lower free floats or lower volumes. But I would not want to buy it because I don't like the business. So, of course, in the short term, I'll miss out, but it's also about managing the risk. More so in the small cap, but mid cap, that's what gives me the fear. If you do mid cap investing, all 150 stocks will be a part of your portfolio. It's not like a Nifty index fund where 50 stocks are there, the top 50, but 150 might still have some bad apples, not necessarily from the business standpoint, but at least from the price and the valuation standpoint.
And so these funds have a sector allocation. Any similarities in that? What's been the specific as far as the exposure of these funds are concerned?
Yes, I think finance and bank in both these have been 20%, 22% as a total. This year, largely financial services has done its duty in terms of earnings also, and also the performance. And since it's the largest weightage in most of the indices, these funds also have about 20%, close to 20% in Mahindra Fund, and close to about 21, 22% again in the Nippon India Growth Fund for these two sectors.
All right, so Nippon India Growth and Mahindra Manulife Midcap in the midcap category. Next on your list is Feroze?
Multicap fund, Kavita. And that's a category which is reasonably well diversified, because as a fund manager's mandate, SEBI says that you'll have to have 25% each in all the three categories, which is a mandate. Then you have only a discretion of the other 25%, which you can put in any of the three categories. So 25, 25, 25 totals to 75. The other 25 is at a discretion. So Nippon India Multicap Fund, again, one from Nippon's stable, is 40% in large cap, 28 in mid cap, and 32 in small cap. So of course, the discretionary 25% has largely been skewed towards large cap, and rightly so. This fund has generated 3.3% alpha over its benchmark. So it's but obvious that this category has been the best, one of the best for this financial year so far, because mid-cap category, the best fund has underperformed, but here the best fund has actually outperformed the benchmark by about 3.3%.
And a similar case in flexi cap, or it's slightly different because most of these flexi caps have been large cap biased, or we've seen better alpha in flexi cap also?
No, FlexiCap has delivered lesser alpha because FlexiCap gives you more flexibility, and fund managers have had this tendency of making FlexiCaps large cap heavy. So in a year like this year, where 15-20% alpha has come over Nifty with respect to mid cap and small caps respectively, so some FlexiCaps have underperformed a multi-cap fund because there's no such mandate to have at least 25%. So if you see the other fund, which I was going to speak about on the Kotak Multicap, in the multi-cap category, Kotak Multicap, which is Harsha Upadhyay is the person who manages this, also has 40, 25 and 27 in large, mid and small respectively. So all these funds have a serious exposure to mid-cap and small cap, unlike a flexi cap, which turns to be a large cap heavy kind of a strategy.
All right, quickly we move on, and the next category in focus is focus funds. This is going to be interesting.
Correct. The focus fund as a category, to my mind, is the mutual fund's answer to PMS. Because PMSs generally have a large exposure of HNIs. For a retail person, focused as a category is the retail man's PMS, with huge transparency, great tax efficiency, no separate demat account. So focus funds are a great niche in themselves, because you can't have more than 30 stocks in a portfolio. But if you speak of a mid-cap fund, there are mid-cap funds with 70, 80 stocks in their portfolio. But a focus fund, on the contrary, is by mandate restricted to 30, and several of them don't even use those full 30 and have 20, 25 stocks in their portfolio. So Nippon India Focus Equity Fund again has generated a decent alpha of 2.7% on its benchmark, and still has a PE of 20p, 20.39. Again, large cap biased with 52% in large cap, 28 in small cap, and mid cap is smaller than mid cap is smaller than the small cap exposure, which is a very rare thing to find. 28% in small and 17% in mid, and 52% in large is what this fund stands out for.
Looking at this category, it's a very concentrated category, which should also suit an investor's risk appetite. Talking about sector allocation, what's been very specific for these funds?
I think most of these funds which have come on the top they've got their sector allocation right in terms of banking and IT. Sorry, Kavita, there's so much monotony in terms of this answer because these two sectors have contributed to the alpha, and the ones which we are checking are the high alpha ones. So again, these have close to 35% each, 30 to 35% each in finance, banking, and also these two have one little difference. They have entertainment and pharmaceutical. Pharma is almost about 11% in DSP focused fund, which is the next focused fund, which generated about 4% alpha over its benchmark. So pharma stands out as an exposure, and entertainment stands out as an exposure to Nippon, India focused equity fund.
I think there's some technical issue. We're going to come back to you till the time you fix that technical issue. But I'm just going to rewind and announce the name of the funds that Feroze also figured out. And in fact, as per his research, the kind of alpha these funds have been generating. So in large cap category, you have large cap, you have Nippon India large cap with alpha close to 5.7, HDFC top 100, 2.2%. The next category is mid cap, where the funds names are Mahindra Manulife large and mid cap, and over here it's 5.7. That's the alpha for a large cap fund, and the mid cap category you have minus 1.1%. We move on, and I think I've got Feroze back. Feroze, the next category quickly. Let's talk about small cap.
Yes, absolutely, Kavita. If you look at small cap, Aditya Birla Small Cap is the small cap fund, which is the best small cap fund from a performance standpoint. And if you look at it, it's of course a part of our model portfolio for the last year and a half. It was a very bad performer for last year, but now it comes to the top. So why this is important is past performance is not an indication of the future, is exemplified with this example. Like last year when we chose it in the model portfolio, its past performance was so abysmal that it would be very difficult for an investor to cut a check into this fund. And this year, this financial year, it turns out to be the best out of the huge list of small cap funds. So that's Aditya Birla Small Cap. Vishal Ji is the fund manager, great fund manager who moved from PMS last year, April, to manage this fund. He used to manage the PMS in the same company, which is Birla. So this is one fund which has given 36% return, but still has a negative alpha. So that's the second point to note. A negative alpha in the test fund implies that all fund managers in the small cap have not been able to catch up with the benchmark, because the benchmark is running helter-skelter in terms of where liquidity is taking it.
And a similar case in the other small cap fund that you've listed out?
Yes, Bandhan Emerging Business Fund is also one of the funds which has a very similar one. And Manish Punwani is the person who moved from Nippon as the CIO to Bandhan, and that's the fund manager for this specific fund.
All right, let's move on. And the last category in focus we'll take is contra and dividend yield. Is that the category that you're focusing on now?
Yes, Kapita, the second, the Contra fund, again, SBI Contra, which is a part of our model portfolio for the last 2.5 years, has generated about 3.1% alpha. Value as a fund principle they followed, the 17 is the PE of the weighted average constituents of the portfolio, which I think is reasonably low. Pharmaceutical is one of the sectors which stand out. Apart from it, power, which is also one of the sectors which has 5% allocation. So these two sectors have given a reasonable alpha to this fund, and in turn pushed it up right up in the category itself.
All right. So the time is up for me for this discussion, but then I really want you to help our viewers understand the way the viewers can have these kind of funds in their portfolio, the kind of exposure and the kind of placement they should be having, because that's the benefit of having an active strategy. You get the benefit of a fund manager's expertise that we also saw when we got the alpha generating numbers to Feroze. But then Feroze, talking about the placement or allocation in the portfolio, how should one decide on that?
To my mind, first, the implied exposure of at least 50-55% in large cap, 20% in mid cap, and about 25% in small cap. On 2nd January 2023 is when we realized that small cap is going to go through a huge price rating or PE re-rating. So coming back to your point, Kavita ji, 55, 20 and 25 in terms of market cap allocation. The funds which you should choose from should be in multi-cap category, large cap category, contra, dividend yield, flexi cap. These are 5 sectors you can, 5 categories you should certainly focus on, and one large other category could be a focused fund, which is SBI Contra. These 5-6 categories is what you should focus on, and not get into sectorial bets, especially in a year which is preceding a general election.
All right. I think with that, that will be all. Thank you so much, Feroze, for taking time out and helping our viewers today. Thank you. We'll be slipping into a short break, but then post that, let's understand how to rebalance the exposure of mid and small cap in your portfolio. I'll be joined by Arun Kumar from Funds India after this break.